Hello, and welcome to the 2026 Property Market Update for South Australia and the Northern Territory. My name's Angus Moore. I'm the Executive Manager for Economics at REA Group. Today, I'm going to be taking you through what we're seeing in housing markets, as well as the broader economic fundamentals that are underpinning housing. To that end, I'll start with a bit of an economic overview, very high level, mostly focusing nationally because a lot of economic conditions is national, but with a little bit of state-specific flavour. That will really underpin what we're seeing in terms of housing as we move into section two, where we'll look at what we're seeing in established housing markets, what home prices are doing, what activity's been doing. I'm then going to move on to talk a little bit about rental markets, both because rental markets are interesting in their own right, but also because of what we're seeing from investors and what that means for investor activity, because that's been a really important story over the last 12 months or so. And then I'll finish up with a few thoughts that set themes for 2026 and what we might expect going into this year. So, starting with those broad fundamental economic underlying conditions, the story over the past really 6 months, maybe a little bit less, has really been inflation. Inflation came in much stronger than expected over the back half of 2025. And this chart is, I think, the best way to see that. What I'm showing here is what we call underlying inflation. This is the measure of inflation that the RBA likes to rely on the most. It strips out the sort of one-off effects, think things like electricity subsidies or, wild changes in fuel prices that they're not really predictive of where inflation is going. They're sort of a one-off thing. So this measure strips those out. A couple of things will really stand out from the chart. First, you can see that huge spike up in inflation that we saw coming out of the pandemic. That's why we saw those really rapid interest rate increases from the RBA in 2022 and 2023. But the other feature will stand out is the fact that we got pretty close to, back towards the RBA's target band. Inflation was actually inside the target band, albeit on the high end of the band for a little bit, but has then moved back out. And the RBA is expecting that that's going to continue. They're expecting that inflation on an underlying basis is going to continue to increase through this year and won't be back inside their target band for probably 18 months or so. There's been a lot of things driving that, and we'll talk a little bit about, some of the drivers of inflation, but this has really been the thing that's absolutely front and center for the RBA. And, as you'll be well aware, that's why we've seen rate hikes already this year, and we're probably expecting to see some more. So this chart here is showing the average new mortgage rate for a borrower, for an owner-occupier borrower specifically. That is, if they were to buy a house today, walked up to a bank, on average, what sort of mortgage rate are they getting? And then in the dashed line there, you can see what markets are expecting is going to happen over the next couple years. So after a few rate cuts last year in 2025, we've already seen one of those reversed this year, and markets are expecting at least one more and about a 40%, maybe 50-50, depending on the day, chance of a second hike by the end of this year. What that means is rates won't get back to as high as they were at the start of last year before we saw those three cuts, but we will start to get back towards that level. So we talked a lot about inflation, and that's clearly an important part of what's driving this. That is what the RBA is laser focused on. But it's not the only factor supporting those rate hikes. The other thing that's supporting rate hikes is this, the unemployment rate. So what I'm showing here is a bit over 5 decades worth of the unemployment rate. And as you can see at the moment in the purple, we are at very low levels relative to what has been true historically. Now, this is unequivocally a good thing. Unemployment is obviously bad broadly, but it's also bad specifically for housing markets. Low unemployment, people in jobs obviously supports housing demand. But it does also support the case for rate hikes. On the RBA's best guess, the labour market is a bit tighter than what they term neutral. That's a bit of a slippery concept to exactly nail down, but they think of neutral as being sort of the pace at which the economy is running where inflation's not going to get out of control. And the fact that inflation is moving up suggests that both we're running a bit tighter than they would like, and you can see that in the unemployment rate as well. Now, the RBA forecast there, you can see they are expecting that unemployment is going to be drifting up a little bit from where it is today, kind of continuing that slow drift up that we have been seeing over recent years, but will still remain relatively low by historical standards. Importantly, we actually saw unemployment come down a bit at the back end of last year, alongside inflation accelerating, which is another reason why the RBA, felt the case for a hike was pretty strong. So What's driving that? Why are we seeing strong unemployment? Why does it look like inflation has picked back up again? Part of the story is that consumer spending, after a pretty soft period, has started to pick back up. So this chart here is showing the change in household spending relative to pre-pandemic. So, kind of end 2019. You can see that big drop down during the pandemic. Hardly a surprise. People couldn't go out, couldn't spend. Saw that big ramp up as we reopened the economy, borders reopened. We saw a big pickup in spending. But then through 2023 and then particularly 2024, household spending largely tracks sideways. It's drifting up a little bit, but this is also in total. So this is not per capita per household. This is total spending. And this was a period of very strong population growth. So in per capita terms, household spending was relatively soft. But you can see towards the back end of last year, that started to pick up. We started to see aggregate household spending growing more quickly. And that's despite the fact that population is actually growing more slowly now than it was, 18 months ago. So that consumer spending firming up is supporting that low unemployment and is probably also supporting inflation. Another way to see that, and something the RBA put a lot of stock in, is what's contributing to economic growth. So it's a relatively complicated chart, but the way to read this is it shows the contributions to growth from the various different types of spending in the economy. So in the red, which is the one to focus on, is private spending. The more positive the bar, the bigger the bar, the more that private sector spending is contributing to economic growth. And then in the blue is public sector spending. So if we zoom in on sort of 2024, 2025, you can see growth in private sector spending was very soft. In fact, it was almost contributing nothing to economic growth over that period. And growth was really buoyed by government spending. Things like state government infrastructure projects, but also things like Medicare, NDIS, and the like. That's starting to shift now. We're starting to see a slowdown in government spending, particularly as some of those state infrastructure projects wind up. And we're starting to see a bigger contribution from the private sector, household spending, as we mentioned, but also business investment as well. And that's contributing to demand, contributing to stronger economic growth, and contributing to inflation. To wrap up on economic conditions, I'm going to talk a little bit about population and talk a little bit about South Australia and the Northern Territory a bit more specifically. So the chart on the left here is showing annual population growth for the country as a whole in purple and for South Australia specifically in the orange. Two things to note from the chart. One, we've been through a period of very strong population growth, both in SA and nationally. That was due to borders reopening, and we'll talk about that in a second, but that has largely subsided now, and we've kind of come back to a more typical pace of growth. The second fact that you'll notice is that South Australia typically grows slower than other states, and we'll talk about that now. The chart on the right shows what drives population growth. So in blue is the contributions to population growth from net overseas migration, and in red from net interstate migration. That is, people moving into SA, less people leaving it. So you can see that big surge in overseas migration that we saw post borders reopening. That process has largely worked through now, sitting here in 2026, kind of 4 years out from borders reopening. We've mostly worked through that adjustment period, and that contribution and population growth has kind of come back to a more steady state. But the more interesting one, particularly for South Australia, is those red bars, interstate migration. You can see that typically over history, those red bars are negative. That is, more people move out of South Australia to other states than move into it. During the pandemic, that flipped, and flipped in quite a big way. We were seeing pretty solid contributions from people moving into South Australia. And that was clearly an important contributor to housing demand over that period. And part of why, as we'll talk about in a moment, Adelaide and regional SA have seen such strong growth in home prices. But that process has largely worked its way through, and we have seen that flip back. So South Australia is now again on net losing people to other states more than are moving to it, though the flows are not particularly large and certainly less than what is typical for South Australia. That is, we are still seeing, relative to what's true, quite a lot of people moving in to South Australia. And that is still going to be contributing to housing demand. For the Northern Territory, the story is a bit different. The Northern Territory is obviously a much smaller region, so population growth can be a lot more volatile, as you can see on the chart here. Northern Territory is still seeing quite strong net overseas migration at the moment, and it didn't see as strong, and it's not seeing as strong inflows or contribution from net interstate migration. In fact, typically people are moving out of the Northern Territory. That's not always true over history. You can see periods there, particularly during the mining boom, when there were more people moving into the NT than leaving it. There was some of that during the pandemic, though not as strong as what we saw in South Australia. And we are still seeing, around typical outflows to other states at the moment. But the fact that overseas migration is still quite strong into the NT means population growth there is relatively firm for what's typical in the NT, and that is part of what's supporting housing demand. And just to wrap up before we move on to housing markets, jumping back to Adelaide, where are we seeing people move in Adelaide? And the short answer is the north. So the chart on the left here is showing internal migration. That is, more purple means people are leaving it, and more red means more people are moving to that region. And then on the right is total population growth. So that's internal migration plus people coming in from overseas. So you can see on the right, all parts of Adelaide are growing because people are moving here from overseas, though the north especially so. But if we're looking at internal migration, people are actually moving out. People that already live here are actually moving out of inner city areas and moving north, moving, to the east as well into the hills. So that's contributing to housing demand in those typically more affordable, development heavy areas. All right, let's use that as a bridge to talk about home prices and what we're seeing in the established market at the moment. This chart here is showing what's happened to home prices over the past 6 years or so. So you see on the left there, Adelaide in the orange and Darwin in the green. The key thing that you'll note here is Adelaide home prices have more than doubled, that is growth of more than 100% since the start of 2020. That is an astonishing run of growth over a period of just 6 years, and far outstrips what we've seen nationally or what we've seen in Sydney and Melbourne that you can see there on the right, Melbourne especially, where prices have been really quite stagnant. Now, that's not unique to Adelaide. You can see on the right there, I've got Brisbane. Perth looks very similar. Those have seen very similar performance to Adelaide in terms of prices, like more or less doubling or a little over this period. What's particularly interesting for Adelaide is that actually that strong run of growth continued through 2025. Prices were still up double-digit pace, up 14% over 2025, which is pretty strong in an environment in which prices have already more than doubled and affordability is very challenging. The story for Darwin is a little bit different. We haven't seen as strong a run for Darwin over the sort of preceding 5 years before 2025. And in fact, prices were pretty sluggish from the time the RBA started raising rates in 2022 through to about the end of 2024. Now, Darwin's not alone there. Sydney and Melbourne look pretty similar. But Darwin's had a very strong 2025, very strong. Prices are up a double-digit pace over 2025. And that's in part because of the population growth that we were talking before, but it's also in part from investors, which we'll talk about in a moment. Drilling into Adelaide a little bit more, we haven't seen a huge divergence in the performance between detached houses in the pink and higher density, so units and semi-detached, in the yellow. Since about 2022, these two lines have largely tracked together. We did see a gap open up during the pandemic where detached houses did perform better across the pandemic period. That's a pattern we see across most of the country. That's not unique to Adelaide. People during that period were very focused on having a bit more space at home, having a backyard. And so we saw the premium for houses over units widen. But since that time, the two have largely been tracking. That premium that opened up hasn't closed. But equally, we haven't seen detached houses pulling away. If we're looking over the past year, again, relatively similar performance. There is a little bit of a gap, but it's not huge and certainly nothing I'd draw attention to. Where there maybe has been a bit of a difference is that we have seen more affordable parts of the market, here shown in blue, outperforming other parts of the market. And that's consistent with very challenging affordability conditions. Again, this is not something that's unique to Adelaide. This is a pattern we've seen, broadly speaking, across a lot of the country, where the more affordable segments have outperformed a bit since the RBA started raising rates in 2022. Again, the gap here is not huge. The sort of mid and higher end of the markets have still done very, very well with prices, having doubled in those segments over the last, 5.5, 6 years. But we have seen a bit of a gap open up between the sort of more affordable parts and the rest of the market. And you can see that in the geography as well. So this chart here is just showing home price growth across the city. More red means faster growth, and you can see that it is that sort of far north that has been standing out over the past year. And those more expensive areas, places like Burnside, the sort of CBD and inner south, have still seen pretty strong growth. I don't want to pretend that they're not growing by any means, but just not as strong as we've seen in some of those more affordable parts of the city. Moving away from home prices now, activity has been a little quiet, and we have seen somewhat limited supply in Adelaide. That's been supporting home price growth. So, to walk through these charts a little bit more, what I'm showing here is the number of new listings by month. And I do this because listings are very seasonal. You can see there, December, we get very few listings, as you'd expect. Spring obviously sees a lot. And then the line traces out each calendar year, and that allows you to sort of compare year to year. And the black is showing you what an average year is. So you can see in the red for 2024 was largely around average in terms of new supply hitting market, while 2025 was a bit below average, particularly through sort of late winter and into the start of spring. Even the peak through sort of October, November was only around or a bit below average. And so the fact there just hasn't been as much choice for buyers has probably at the margin been supporting home price growth a bit in Adelaide. In Darwin, it's a similar-ish story. We haven't seen a particularly busy year for Darwin in 2025 in the blue there. It's been, obviously a bit more volatile given that Darwin is a smaller market, but it has been sort of roughly around average. And that's a bit in contrast to what we saw in 2024 when there was actually a reasonable amount, particularly earlier in the year, of new supply hitting market. All right, I'm going to move on and talk about rental markets for a little bit, and then move that as a bridge into talking about what we're seeing from investors who are a really, really key part of housing markets at the moment. So let's start where I always like to start on rental markets, which is the rental vacancy rate. So this is just showing at any given point in time the share of rentals that were available for a tenant to move into as a share of the total number of rentals. As you will immediately notice from this chart, particularly somewhere in smaller markets like Darwin, this can be very volatile from month to month. It depends on seasonal conditions. Obviously, January is when a lot of people move, and so a lot more rentals become available. But it also depends on when in the month people move out, because this isn't as at the end of the month how many were vacant. So it can be a bit volatile month to month, but we try and sort of smooth through, look through the trends that we're seeing. The trends that we're seeing are that rental availability remains very, very low and very, very challenging. You can see, rental vacancy rates in Adelaide are sort of around 1.5 to 1.25, depending on the month that we're looking at. In Darwin, obviously a lot more volatile, but still well sub 2 through much of last year, and that remains the case. This is not unique to Adelaide and Darwin. If you're looking on the right for the combined capital cities or combined regional areas, we are seeing rental vacancy rates in that order of 1.5 or a little bit below. The good news for renters, though, is this is a little improved, and I do want to stress a little, but a little improved from the really, really limited availability we were seeing back in sort of 2022 in Adelaide. For other capital cities, it was more like 2023 that was sort of the real trough in availability. At that time, vacancy rates were routinely below 1%, which is just extraordinarily tight. So it's still a very challenging picture. It is still very competitive to find a rental, still not a lot of available supply, but it doesn't look quite as competitive as perhaps it was through 2022, 2023. What that means is that average median advertised rents are still growing because availability is still tight, it's still competitive, that's still pushing up rents. But the pace of growth has slowed down a bit. If we're looking at Adelaide, rents are up, sort of 3.5% in the past year. That's still pretty solid growth. That's still faster than what was typical pre-pandemic, as you can see from the chart here. The line is just nowhere near as steep, kind of pre-2019. It's still faster than, the kind of middle of the inflation targeting band, sort of 2.5, which is what you might think of as a sort of neutral long run rate for rents to be growing. So it's still solid, but it is nothing like the sort of pace we were seeing in 2022, in 2023, when rents were going, double digit rates, even north of 15%, depending on when you were looking in Adelaide, and in other parts of the country. So still a very challenging picture for renters, but starting to improve. Darwin has had a little bit of a different trajectory from other parts of the country. It didn't see as tight rental markets through that 2022, 2023 period. But with that population growth that we've been seeing, rents have, and the fact that vacancy rates have come down a lot, rents have been growing relatively briskly over the last, year or two. You can see there, rent growth is up sort of high single digits in the past 12 months, which is solid. Certainly nothing like what we were seeing in Adelaide in 2022, but still, very strong growth. What that means for investors is we are seeing a lot of investor activity. So the two charts here are showing the number of new investor loans issued each quarter, which is a really nice way of thinking about, how many investor purchases we're seeing, because most investors will be buying with a loan, and this is kind of the best proxy we have for investor purchases. You can see, Adelaide, there was that busy period during the pandemic, but then as the RBA raises rates, we see it quiet off. You can see that to some extent in the Northern Territory as well, though, it is just a much smaller market, as you can tell from the numbers that we're talking on the left of the slide there. But then, sort of post 2023, rates stabilize, rental markets are still very, very tight. We start to see a lot of investor activity, and we start to see that investor activity picking up, particularly sharply in the Northern Territory, though, we are talking small numbers here, sort of 600 total over a 3-month period. But even in Adelaide, we're hitting record levels of investor participation and investor purchases at the moment, despite, and that's even despite the fact, relative to the pandemic, which was a very busy time for housing markets generally. Drilling into Adelaide a little bit more, we're seeing this investor activity concentrated in those more affordable parts of the city. You can see, Elizabeth, Anglevale, Manapara up the north there are very popular with investors. And in terms of where they're inquiring on realestate.com.au, they are really overrepresented in these areas. You can also see, unsurprisingly, the inner city is a very popular area for investors as well. It's, a large, liquid, deep rental market. So the fact that there's a lot of investors looking there is hardly surprising. But those more affordable areas are very popular as well. Again, this is not unique to Adelaide. This is something we see kind of across our cities. So it's certainly not a unique pattern, but certainly driving some of that growth that we've been seeing in those more affordable areas. Just to kind of wrap up and underscore, just how important investors are in the housing market at the moment, I really like this chart, and I use it a lot. What this shows is the share of new loans that are going to investors. So at the moment, circa 40% of loans in South Australia are going to investors. That doesn't quite mean 40% of purchases, because some people, and more likely for owner occupier than for investors, some people will be buying without a loan, but it's still a nice way to think about the pool of buyers that are in the market at the moment. That 40% represents a just shy of record, and it's just shy because it was very slightly higher in September than it was in December. So very, very high investor participation in South Australia at the moment. Northern Territory, exactly the same story. A little bit north of 40%. Again, not quite a record because September was the record, but we're splitting hairs a bit. Near or at record levels of investor participation. That's not unique to South Australia and the Northern Territory. We're seeing close to record highs in WA, close to record highs in Queensland. You can see New South Wales, it's pretty high relative to what's been true historically. You have to go back to 2017 before you find a higher share of investor participation. Victoria is the one that really stands out here. We just haven't seen a lot of investor activity in Victoria. There's a few reasons for that. I won't get into them too much. But even there, we have actually started to see a ramp up over the back half of 2025. You can see that line ticking up relatively sharply there. So investors are really just pretty active kind of right around the country at the moment. That's a nice bridge into kind of wrapping up with some of the themes that I think are going to be important over the next, 12 or 18 months. I'm going to start with maybe a little bit of a downer, which is the new homes market remains pretty challenging. This chart here is showing the number of homes that we've actually built each quarter. In blue is higher density, in red is detached houses. On the left is the total nationally, and then I've got South Australia and the Northern Territory. I'll focus most of my comments on the sort of national, but a lot of this applies to the South Australia and Northern Territory as well. You can see that the pace of building detached houses really hasn't changed very much over 2 or 3 decades. We still build more or less the same number of detached houses. And that's a little surprising at the moment because we did see a big surge in approvals and commencements for detached houses during the pandemic on the back of home builder. But that didn't translate into actually built homes for a variety of reasons. Escalating costs was part of it, but also it took a lot longer to build homes, and it was very difficult to find labor. The good news, and that hasn't translated yet, but the good news is those headwinds are starting to abate. Labor availability is still tight, but it does look like it's starting to improve. Costs are still high, and look, they're not going to come down, but we're not seeing the pace of cost growth that we were in 2021 and 2022. So there's just a bit more certainty about costs for builders, which makes things just that little bit easier. And we're also starting to see build times come down a bit. They're still longer than they were pre-pandemic, but they have started moving in the right direction. So while we're still a long way behind the target pace, the National Cabinet target of 1.2 million homes over 5 years, we're still well behind that. There are some signs that things are maybe beginning to move in the right direction. One of the other, I think, big important themes we're going to see this year is first home buyers. Government's obviously got a couple new policies that came into effect at the end of 2025 to support first home buyers. So those are the Australian Government 5% deposit scheme and the Help to Buy scheme. So the Australian Government 5% deposit scheme does what it says on the tin. It allows a first home buyer to buy with a 5% deposit, but not have to pay LMI because the government essentially underwrites that LMI. This is a program that's existed for a while, but was expanded as of 1 October to remove income caps and to remove the cap on the number of places, which used to be 50,000. There is still a cap on how expensive the home you buy can be, though those caps are relatively high. It's 900,000 in Adelaide, 600,000 in Darwin. Some first home buyers that will be a constraint, but for many that may not be an issue. This will unequivocally pull forward some first home buyer demand, and there's maybe some evidence we've seen that already. So this chart here is showing the number of new first home buyer loans nationally for each quarter. And you can see if we zoom right into the very end there, the last 3 months of last year, which cover the first 3 months of operation of this expanded deposit scheme, did see a bit of a tick up in first home buyers. Now, we can't necessarily pin that on the Australian Government 5% deposit scheme. Obviously, the number of loans to first home buyers moves around for a lot of reasons. But it does suggest there's maybe something there and that we're already starting to see the impact, which was a little surprising to me. The fact that the scheme was only expanded on 1 October, I probably wouldn't have expected that to actually translate into housing activity for a few months because, it takes time to find a home and for people to take advantage of that scheme. So maybe some early evidence here, but it's certainly something that we'll be watching and will be more of an impact on those more affordable parts of the market that, as we've discussed already, have already been outperforming. And just to wrap up, the other theme that's going to really matter for 2026, and we spoke about this right at the start, and we'll speak about it right here at the end, is inflation. And I like this chart as a way to kind of underscore that point. So what this is showing here in black is the actual path of the RBA cash rate target. And then in the different colors, what markets were expecting at different points in time. So in the red is, only about 4 months ago, a little bit less, in late October, before we got the September quarter CPI data. And at that time, we were expecting a couple cuts to the cash rate. Then we got that inflation data that showed, inflation looked more persistent. It had moved up, was moving away from the RBA. We go to the blue line. And then after that blue line, we get the December quarter data, which showed, yep, no, inflation's going the wrong way. And in fact, even more than we thought it was. And that brings us to the purple line today, where we're expecting, at least one and potentially, 50-50, maybe 40%, depending on the day you look, chance of a second cut by the end of the year. That's a big swing. I think it's nice to highlight just how much this outlook has swung in a relatively short period of time. But it also underscores that inflation is what's driving this outlook. It was those surprisingly strong inflation releases that have changed this outlook. And so what happens to inflation over 2026 is going to be the factor that matters for where the cash rate goes from here. If it stays persistent, we may well see those one or two increases. But if things start to head in the right direction, back inside the RBA's target band, it's not as persistent as they're expecting. We may not need to see as many hikes or even potentially start to see cuts if things head in the right direction. Thank you very much for your time. I hope you found that helpful. My name was Angus, and we'll see you next time.